Silver's been stuck in a range, 50-buck highs in 1980, 2011, and even recently either side of 50, for 50 years. What's going on here? I can go show you a chart of copper. Go back to the 70s, 1980s, 1990s, into 2000. And in 2007, after multiple decades of horizontal reality for copper, it broke out, and within a couple quarters, it quadrupled in price. It's late 2005, 2006. And yeah, there was a sharp sell-off after that, but you then, hence, after that surge, a quadrupling in price, you lived in a multi-decade range that is like 3 to 4 times the average price of what prevailed the 70s, 80s, 90s, 2000 for copper. Same is true for lead. Very exciting metal, right? It lived in a multi-decade range, and in 2007, not in sync with copper, a year and a half later, it quadrupled in price in a couple quarters, and since then has lived in a range that's roughly 4 times the price average of that prior multi-decade range. Why is silver still stuck in its 50-year range? Well, there's fundamental arguments for that. Manipulation, attempt to control by some major banks, no doubt with the nod of a head from the Fed, and so forth.
Michael Oliver says silver and gold are breaking out of decades-long bases, kicking off a major shift out of stocks and into monetary metals. He predicts silver could launch from the 40s to 100 to 200 plus within months, similar to the explosive 1979 to 80 move. With 5 years of silver deficits, rising AI solar demand, a weakening stock market, and an approaching debt crisis, Oliver warns this is a fast, historic repricing, and silver is set to lead. Thanks for watching. Subscribe to Fine Metals for more updates.
Silver, we argue, has been in the same position except on the downside. It's been too low, too contained for too long, and when it finally unleashes, what happens in those type of events is when a market has created a false reality, fooled people into thinking that's where it deserves to be, and when it wakes up, it not only goes to a new reality, but it often overshoots it, and it doesn't take years to get there. It often takes just a couple quarters of a massive tantrum. I think that's what silver is about to produce, meaning not only is it going to beat gold, not only are monetary metals going to beat the stock market, but silver could quadruple or even quintuple in a matter of a couple quarters after that spread breaks out, registering the breakout silver versus gold. Meaning we might go up for a couple more years and probably stay up there because the world is going to shift out of fiat currencies in this next crisis, is our argument. But just getting there could be a stellar event for silver. And so we're telling people, if you want to get into monetary metals, put some emphasis on silver, because you might be stunned and smiling greatly at what it does in the initial couple quarters of that move. And I think we're right there. We're right at the doorstep. Now, maybe the reality, for instance, Eric Sprott, it was most influential guy in the silver market, has expressed the view, and it probably ought to be 200. And that's simply, going back and looking, if it was 50 in 1980, and if it was 50 in 2011, if you merely factor in the ongoing decay in the real value of the buying power of the dollar, you're challenging now a massive spread breakout base. For not only is gold saying, I'm going to break out versus the stock market, silver saying, I'm going to break out versus gold on a relative place to be. And so if the monetary metals are now moving into a fresh, massive asset class shift versus the S&P, the U.S. stock market, silver is also saying the same thing, except I'm no longer going to be the little dog that follows behind gold. I'm going to outpace gold. So if you're going to shift to monetary metals now, and if you're not in these markets, for example, a lot of people aren't, I'm suggesting, MSA is arguing, that the metrics that we're talking about here are saying something big is about to begin in terms of asset class shift, favoring monetary metals, but especially silver. And it's starting now. We've seen congestion in silver since October. So we've had 2 months of They sell it, they drop it down, goes back up. They sell it again, drops back down, goes back up. And now for the third time, we're pressing up into the lower 50s. We're $53 now. By the way, we'll rotate our analysis now to March silver starting the 1st of December, when December silver goes into delivery. Also, we'll be shifting out of December gold and shifting to February 2026 contract. And already, when you look at the March silver, it's up to 53.5 area, meaning it's almost ready to touch top tick again, which is 54 in that recent rally on a $1 scale. But that's not the issue to us. The issue to us is that relative performance breakout, gold, S&P, and secondarily, silver says, okay, yeah, the monetary metals are going to go up, but this time I'm not going to be behind you. I'm going to lead. And I think the same applies to investors who don't want to necessarily buy silver futures or calls on silver ETFs, bullion ETFs. Well, silver has been a monetary metal as well, including in the U.S. at times, okay? So it's not the only monetary metal. There's other governments out there that are even looking at silver in that regard. But it will go up with gold. But the main point I'm making right now is it's just on the industrial side of silver, which it has, which gold doesn't have. The supply demand for silver has been excess demand every year for like 5 years now. Supply can't meet the demand. And the demand is high tech. There's all this AI talk we have. Silver's involved in all of that in micro basis, but massive quantities. And it's also involved in solar. And solar is quite important in many parts of the world now where you don't have public utilities and so forth, but you're in Africa somewhere, or you're in remote parts of Asia, and the Chinese are satisfying that demand by creating solar cells and solar panels with silver is essential in the silver cell process. And it's those two factors alone are just dwarfing the new supply of silver. And one of the problems with the supply of silver is that it doesn't come from silver mines. Yeah, so about a third of it does, as I understand, but most of it comes from base metal mining. And so the company that produces a lot of silver might not be primarily focused on whether the price of silver is up to increase their production of, let's say, magnesium or copper or something. It's not motivating them to increase production. Why? Because it's marginal in their overall operation. So that's sort of a unique situation for silver supply-demand issue. But as far as monetary metals, it has always been one. Don't forget that. Two charts that we're looking at. Neither one of them are simple price charts, which everybody is deluded by one way or the other. That's why there's a chorus of folks still calling every time the gold flinches, it's got to correct, et cetera, or it's the top. There is a relationship between gold and the S&P 500 or the U.S. stock market bubble, and you can plot it. It's called a spread relationship. We simply divide the front month of active contract of gold futures into the price of the S&P and express that as a percent. And we plot it, okay? Every end of every month, we plot one little dot, okay? When you plot that chart, we've shown it in prior reports, you've got a 11-year wide base on that chart, where gold back in 2011 was at a higher relative level to the S&P. And during its bear market, 2011 through, especially 2013 through 15, gold dropped, but also its relative performance dropped to the S&P. But then actually since 2014-15, you could basically take that same spread chart, draw a line sideways, and gold's been above and below and above and below. It's really been par to the S&P. Depends on when you bought gold relative to the S&P, you're doing better. Now, especially since 2024, that spread has moved up sharply. Now, when you look at the spread chart, there is a massive, very clear line across every single rally high that relative performance surges have created. So you could take a crayon and have a 5-year-old draw the line for you. Unfortunately, most people don't plot the spread chart. And if you did, you would see that this month's close, we have a half a day trading left, I think on Friday, is out above that base. Meaning that while gold has handily beat the S&P, especially since 2024, coming up from the lower end of that base, it's now punched out above it. So if you were just looking at that chart and I erased the words gold versus S&P and didn't tell you what it was, and you thought, well, that's a price chart of some stock, you'd say, I got to buy that thing, okay? Because you break it out of a base that an idiot could see. But everybody thinks that gold has gone too far, it's got to correct, or it's excessive. I think you've had your sell-offs. You've had a couple sell-offs that got you back into the high 40s. After we got to 52.70 in October, the low was just below 46, okay? And if you look at what happened, it hot-footed out of that hole so fast. If you didn't buy it down there in the upper 40s, it was back up in the 50s again, okay? Then it went to 54, okay? They banged it again. This time you went down to like 48. No, you didn't get to 48, almost got to 48. And then whoosh, now you're where? 53, okay? It comes out of that hole so rapidly because it's my assumption and sort of knowledge. I was talking to some big guys with big money who have been doing that. When that thing breaks under, you see a 40 mark on silver, they come in and put millions into it, okay? And I think they're right. But I think the key is don't look at the price of silver. Don't do Elliott wave stuff. Don't look at RSI or MACD. Overbought is going to have a different definition than what it's had for the last decades. Silver's going to create a new parameter of what overbought is. In fact, you can go back and look even, I think it was in the late 79 to 80 when silver basically went quadrupled to quintupled in 5 months. Okay, that was also when the spread of silver versus gold broke out. Okay, but it was $15 went to 50. Okay. During that time, if you looked at monthly RSI, it was overbought every single month. So if you got out, you missed the move. One of the factors that we noted months ago, MSA did, is that Bitcoin was going to crash. And we got laughed at, of course, naturally. And the feverish investors in that market, a lot of them are young. Unfortunately, a lot of them are large corporations now, have gotten hip deep in the crypto market. It crashed. We went from 127,000 to 82,000 in a matter of 1 month to another month's low. Okay, that you call a crash. And I don't think it's over. You're having a bounce right now, but I think it's BS. I think ultimately you could see Bitcoin, which is like 57% of the crypto market, down in the 60,000 area in the next wave of decline. But it's already done its thing. It's proven to people, hey, what happened here? Well, I think the economic crisis that's about to hit, based on government debt crisis, not mortgages this time, okay? The US, the UK, Japan all have huge government debt crisis problems. In fact, the president of the New York Fed, named Williams, was 2 weeks ago, had a press conference or a speech or whatever, that I'm sure was approved by the Fed in general, where he said, we're going to start buying government bonds now. Quote him, government bonds. And his excuse was, no, it's, no problem there, but it's illiquidity in that market. What does that mean? They're defending the government bond market, meaning they're going to print money. And what's the benefactor of ongoing degradation in the money in it? Gold, monetary metals. And now it's not just a U.S. problem or a Japanese problem or UK or Europe. It's everywhere. And any one of those you can't have turn into a crisis, because if it does, it's too big to fail. You can't have that. And so the central banks will go berserk, and gold knows this. We know we're in a different situation. Plus, we have a U.S. stock market bubble like we've never seen in history. And MSA is arguing since early this year, when S&P was 61.47, into the drop, we said it would bounce at 4,800. Sure enough, it did, and it shot to a new high by 10 or 12, 13%. And we've been laboring up here now for about 4 months in this mid-60, 6,600, 6,700, 6,800 area, just around 7,000 or lower. It's not been really gaining. It's just been hanging in there. We think that is a topping process. Just like the 2000 dot-com high took 1.25 years to finally break it, okay? 2007, before you imploded into 2008, it took like a full year of laborious topping process, including with the Fed rate cut. And I think the stock market right now is probably going to see its real sharp weakness, not this year. You might get some more wobble but is in the first quarter of next year. And that's when suddenly a lot of other assumptions about where to be or what's likely to be the economic outcome or future are going to go out the window when that beast starts to roll over. And again, one of the first initial technical evidences of that, gold breaking out versus the S&P, is a statement. It's saying somebody's moving big money, and it's just beginning.